rare and exclusive conversation with the Fundoo Professor himself, Sanjay Bakshi. In his first ever TV interview, he unpacks the timeless principles of value investing, reveals how to navigate market noise, and shares the key to building wealth and clarity with patience. Here's an excerpt of that masterclass on investing.
Hello and welcome to this rather special show, and I'm calling it special because my guest on the show today is someone I've been wanting to interact with on this forum for almost a decade now. My guest has several introductions: a true blue value investor, a star fund manager, a professor. But I would like to introduce Professor Sanjay Bakshi differently. He's an individual who has dedicated his life in sharing and teaching. He's not only sharing and his ideas about value investing, he is also preparing the next generation to be future ready. The ease with which he can really decipher the complex world of investing with simple ideas is quite extraordinary. So more than anyone else, I'm excited to welcome Sanjay Bakshi for the first time on ET Now. And I mean it when I say it's an honor to have you on the show, sir.
Oh, thank you so much, Nikunj. It's a pleasure to be on the show. It's the first time I'm actually doing a TV interview. I've never done it. And you've tried it for persuading me for almost a decade now. So finally, you got me. Thank you for having me.
Thank you very much. How did you get interested in the world of investing? Because when you started investing in equity markets, investing was not the heart of India. It was minority of Indians were connected with stock markets, and handful of them understood value investing.
You're right, actually, but it's not right to say that there were no interest in equities, because I got interested in this field in early 1990s, and India was going through that famous Harshad Mehta scam, which happened in 92. And I was a student at in London, in the London School of Economics, and I discovered the idea of value investing while I was there. I came across the Warren Buffett letters, and through those letters, I discovered his own teacher, Benjamin Graham. And so my interest in value investing started around the same time when India was actually going through a phenomenal bull market, which was actually scandalous. So, but yeah, at the time, people were mostly buying stocks based on tips, and there was not a lot of method, which has come subsequently. So I have been a part of that journey. So I feel very privileged and honored to have been, part of the growth of the Indian equity markets, and so here we are.
Professor Bakshi, not only you are a true blue value investor, you also are sharing your experiences. More importantly, you are very open about teaching the concepts of behavioral finance and market psychology. When did you gravitate towards teaching?
Oh, it happened at some time in 1998. So I had already spent about 4 years accumulating some experience as an investor in India. In 1998, I got an opportunity to go and teach, and I absolutely enjoyed it. And over time, now I've done it for now, more than 2 decades. I realized that I become a better investor because I'm a teacher, because, teaching sort of reinforces ideas and philosophies that have worked over time. We all change over time. And my own thinking on the subject of investing in businesses have changed over time. And as you teach what you practice, the things that have really worked for you, they tend to get reinforced, because you have to do it over and over again. So that turns you, I think, into a better investor. And of course, students love having a practitioner in the classroom, because in the class I teach about my experiences, my mistakes, the successes, and what I've learned over the years, both directly and through vicariously by studying other investors out there. So it's been a wonderful experience wearing both these hats.
So, Professor Bakshi, allow me to take the clock back 30 years ago, 35 years ago, when you started your journey as a value investor. How has value investing evolved? They say that the rules of the game don't change. Like they say that in stock markets, courses remain the same, it's the horses change. In your mind, how exactly has value investing evolved and will evolve?
I think the fundamental principles of value investing are exactly the same as they were when they were expressed by Ben Graham in his books back in 1934. And there are essentially three key ideas. The first idea is that to treat investing in stocks as if you are buying a stake in a private business which doesn't have a quotation, basically detached from the quotation, focus on the business and the fundamentals. So that's lesson one. The second one is to treat market as a servant and not as your master, and to take advantage of mispricing that will occur because of irrational behavior of the market. And the third lesson is to insist upon a margin of safety, and how to go about implementing those ideas. They may have changed and evolved over the years, but those three big ideas, we can call them first principles, they have remained unchanged. So yeah, evolution is obviously there. Today we have a market where we have high frequency trading with average hold periods of a few milliseconds, to investors whose holding periods, generally speaking, have also dropped over the years. So yeah, all those things have happened, but those three principles that I mentioned, they have not changed, and I think they have stood the test of time, and I think that will continue.
How exactly you think technology has changed value investing or market behavior? There was a time when there was paucity of information, information was an edge. Now it is abundance of information, and how you choose and how you react to information, that is an edge. How exactly do you think information and technology has changed the whole dynamics of value investing?
So I think that's a very interesting question, Nikunj. I teach that in the class also. If you look at from a pure value investing perspective, the things that truly matter in determining whether investment in a certain business will make money for you over time or not, those things have not changed. The number of variables, the number of factors that you have to think about when you think about investing in a certain business, they haven't changed, but the information surrounding them, and not just them, but also many other factors which have an influence on stock prices, but have zero influence on those three or four things that truly matter from a business fundamental point of view, they have grown like crazy. So if to put it in perspective, if you think about it as noise to signal, the noise to signal ratio has become very large, and it's growing exponentially, which means that the signal, which is the little dot in a circle about things that really matter, that remains unchanged, but the circle of information, a lot of which is actually noise, keeps growing over time. So the key trick to learn is to how to focus on the signal, how to not give in to the cacophony around that signal, because with all that cacophony, the signal will get drowned out. So how to identify a signal is a key sort of skill to acquire, and it has always been the case, but it's becoming harder because of the growth in the signal noise to signal ratio. And I think the big lesson for investors is to learn how to focus on what truly matters and ignore everything else. So that's the key thing that has made technology has made that harder, actually, I would say. Today you have a world where people have access to real-time information about companies, about data, about the stock prices. But the things that truly matter from a fundamental point of view, they are things like the quality of the balance sheet, the how much the product is liked by the customers, the competitive advantage it has, and how the business is changing over time. Those things don't change in a single day, whereas all the other things that I talked about, they're new developments happening on a daily basis. So the technology, I think, is actually making it harder for people to focus on the signal.
Professor Bakshi, they say investing is easy, but it is hard to implement. The rules of what to buy, which is you buy a great business at a reasonable price, hold it for a reasonable period of time, and let it compound. It is very simple. We all know that, but it is very hard to implement. Why is that?
Well, that's a great question, and I have a whole, subject that I teach on the around it. So it's all obviously behavioral, and you're absolutely right. The idea that you should buy things when they are cheap, and you should let go of them when they're expensive is a very simple, commonsensical idea. But why is it then a lot of people are not able to implement that? It's just that when things are cheap, there is a lot of pessimism. Pessimism produces fear, and fear makes people worried about what's going to happen tomorrow. So there is this recency effect that plays out. Recent terrible news is extrapolated into the future, and people get scared about making a commitment, a financial commitment at that point of time. And the same thing happens on the other extreme. When things are going well and there is a lot of greed, and there is people who are not in the market, they want to jump in because they're experiencing FOMO, they're experiencing envy, they're seeing their brother-in-laws get rich by speculating in some IPOs which listed at a ridiculous valuation compared to the price that they paid for the stock. So all of those factors and many more, there are about 17, 18 models out there which are part of what we call as behavioral finance. They all contribute to the difficulty of actually implementing the commonsensical point that you made.
Professor Bakshi, if we talk about the current Indian market, one side we've seen large SIPs, which is genuine long-term investing, that culture has got created. On the other hand, there is a large speculation which is happening in the F&O market, where trading volumes are also at an all-time high. Why is that long-term investing and short-term trading coexist? And what does that mean about where the investing culture in India is moving?
Well, I think it's a complex question. If you think about it, again, if you want to simplify the problem, you have to decide whether you want to be a business analyst or a market analyst, and you can be either or you can be both. But I long ago decided to be a business analyst, which means that I don't really want to pay attention to what is happening in the markets. For example, money flows or SIPs, or what the FIIs are doing, or what the Indian mutual funds are doing, and so on and so forth. Those are important factors for many people, to be sure, but not for me. And those are important factors for determining what will happen to the near-term stock prices, but they don't have any impact on the underlying fundamentals of the business. So if your focus is on the business and not on the stock price, because you're training yourself to be a business analyst and not a market analyst, you have to do so many fewer things. The number of moving parts that you have to focus on, drop by, I think, 90%. So to keep things simple, I decided long ago to be a business analyst and not to be a market analyst. So the question that you asked, how will money flows change and how will short-term behavior? Of course, we have always had speculation. It's not going to go away. And of course, I'm not happy about the idea that India is now running the world's largest casino in futures and options trading. And I do think regulators are right to control that, because people have a propensity to gamble. And desire to become rich quickly is very strong. And I think even the founders of the platform Zerodha have disclosed that most day traders actually lose money, and the ones who don't lose money in monetary terms, most of them actually don't even beat the fixed deposit rate of interest. So it's an extremely competitive field with very high mortality rates, but that has not stopped people from getting attracted to it, because you don't get to hear about the losers, you only hear about the winners, and people are attracted to that. So that propensity to gamble has to be sort of reined in, I think, through regulation, through taxation. So I'm all for that. But again, as an investor, I don't pay much attention to those things, because I think if you focus only on the businesses that you want to invest in, and to see if there's a mispriced opportunity out there, that's the only time when the markets become important to me.
Professor Bakshi, mathematically we know that good businesses are hard to find and great businesses are even tougher. And very few companies genuinely can really compound and create a wealth. So when you look at investing, or when you look at identifying a company or a theme or an idea, what is the starting point? How do you start?
It's a good question. Again, there could be many starting points, but um, one very frequent starting point for me has been astonishing financial performance in the past, going back long into the past, which means that you automatically exclude businesses which don't have a long track record. And I think that's important to recognize, because then you can see what happened to that business during stressful periods. COVID was recently a stressful period. I think it was a great sort of environment during which you could study, businesses that have survived and thrived, and those who sort of were completely evaporated, or eliminated from the so-called gene pool. So to study businesses and see how they have done during tough times gives you some idea about, what is called as the Lindy effect. I'm sure you're familiar with that. The longer a business has been around, the more conviction one gets about its ability to survive and thrive in a tough environment. It could come from many factors. It could come from a variable cost structure. It could come from, a strong balance sheet. It could come from diversification across various product categories. It could come from many sources. But if you really study in especially in some sectors, in cyclicals, in financials, if you study, so there is a lot to be said about studying survivors. So when you see that astonishing financial performance, especially during tough periods, and you start looking at the inherent strength of a business, and you start asking questions to why did this business thrive in an environment where others were sort of being eliminated, and then you start focusing on the factors that have gone into creating that business and running that business. And as you mentioned in your question earlier, that it is becoming harder. I don't think so, because when a bear market comes, or where there's some macro factors, or when there is volatility caused by with help with the help of the spread of technology, where manias can spread very, very rapidly. When that happens, then the market has the propensity or tendency to sort of paint everything with the same brush, or to throw the baby out with the bathwater. So when that happens, even great businesses, which may be hard to find, as you mentioned, and but that they exist, but they're just not attractively priced. They tend to become very attractively priced during those periods of time. So for an investor to find a good quality business is obviously a starting point, and it can come from many sources, but it's not that you have to invest in it right away. If you already know it's a great business, and because of some external development, its stock has become ridiculously cheap, then you have to act. Then you have to overcome the loss aversion and the fear factors and all, and get over all those psychological tendencies that I mentioned earlier, and go and act and deploy capital. So while it's difficult to identify great businesses, but it's during severe bear markets, they do become cheap, extremely cheap, and that's the time to actually go and invest into them.
So if I may quote Manjar here, he would always say that you should be ready, you should be prepared. So is that a good strategy for any long-term investor, that just wait for that loose ball and hit it out, identify a good business, but wait for that panic in the market so that you get your price?
That's his strategy, and it worked for him, and that doesn't take away the elegance or the intelligence behind the strategy of being almost fully invested in India. India is a growing market. India market cap has grown from less than $1 trillion 10 years ago to more than $5 trillion now, primarily because of the growth in India's GDP, and also because new companies have come to market. So there is this very large pond in which we are fishing, and that pond is grown to now more than a $5 trillion USD market cap pond, and it's going to keep growing as India grows. So in that sense, I don't see that as a problem at all. The key is to find out just a handful of companies. As you're going to have thousands and thousands of companies which are available for investing. In the job of the investor is not to select but to reject. It's primarily the problem from a mathematical point of view is to reduce from 5,000 odd plus companies to a portfolio of maybe a 10 stock portfolio or a 20 stock portfolio, or even a 100 stock portfolio. So even if you were to, have a very widely diversified 100 stock portfolio, you still have to reject a few thousands of companies. So you need to have rules to quickly say no to what just doesn't make sense. And I think figuring out what those rules are is very important.
In one of your recent blogs, Professor Bakshi, you mentioned to find the size of the pond, which is you need to fish in a large pond. What is the definition of large pond and how can one go about identifying it?
Well, I was referring to just now in the answer to your previous question, we should be sort of grateful that we are not living in Bangladesh or Sri Lanka or Pakistan. We live in what has become a large economy in terms of GDP. And we are almost hitting $4 trillion in GDP. And large GDPs produce large market caps. India's market cap is now more than USD 5 trillion. And by the way, this is after accounting for currency depreciation. And that's just an outcome of being a large economy that keeps getting bigger. But it's also an outcome of the fact that there are businesses that have been part of GDP but are now entering market cap. These are privately held businesses which were not there in the markets but have gone public recently. LIC is the case in point. There are so many of them which are multi-billion-dollar market valuations, but they've gone public. They've been around for a long time and their economic activity contributes to GDP but has not yet entered market cap. So it's a large pond, and the pond is going to get larger, and you are trying to fish in a large pond by constructing a 10, 20, 30, 40, 50 stock portfolio. So I go back to the point I was making, that idea is to construct filters to quickly reject what doesn't make sense. So when you have that, you have to say no to basically almost everything. And there are all sorts of things that will pop up which will excite you or entice you, and you have to basically go to the discipline of what makes sense, because at the end of the day you can't own everything unless you buy an index fund. Even then, an index fund will replicate a 30 or a 50 stock portfolio. Even the indices are rejecting most stocks that are available for investment.
If you like this video, then like, share and subscribe to ET Now.